Hello and welcome back to the Market Lens. I'm Sam Rozzi, manager of Due Diligence. As usual, I'm joined by Cliff Walsh, our Chief Investment Officer. If you've missed any previous episodes, please check them out on YouTube or the Studio 454 video library. With the summer now behind us, we're rapidly approaching the American Portfolios National Conference. Looking forward to some great content from that event and to be virtually connected with our advisors. Let's get right into our news or noise segment on wages. August jobs report shows that wages are rising despite weak overall hiring. Wages rose 4.3 year over year last month, triggering some concern in the bond market as long duration bonds sold off. Is this news or noise?
I think it's noise, potentially damaging noise if you chase it. As we've talked about in the past, comparing data to a time when the economy was shut down makes little sense. So the argument is already on shaky ground. Average hourly earnings went negative in early to mid 2020, so of course the numbers are going to be a bit higher than usual when we go back to a more normalized economy. But more than that, we're seeing short-term friction in the labor market as the economy is close to fully open, but the government is still paying people not to work.
Yeah, anecdotally, I've definitely noticed the trend of declining workers in lower wage service type jobs, but I think that is also spilled over into all job types. Do you think the only way for businesses to attract workers is to increase wages?
No, I think that friction is going away in short order. 10 plus million people are about to no longer receive an extra $300 per week in pandemic unemployment insurance from the government. That's going away this month, so they're going to have to go back to work. Increased supply means downward pressure on wages, not to mention the impact this extra money has on retail sales, which are already slipping before this unemployment kicker goes away.
So you think the bond market got this sell-off wrong?
I do. Inflation is still on everyone's minds, and as you know, long bond investors hate inflation. More recently, the concern has morphed to stagflation. In August, we got the weakest payroll gain since January, yet a sizable uptick in wages, but it's not sustainable. Hiring is going to pick up and wage growth will slow. It's just one component of the handful that I expect to ease in the coming months. Those betting on higher rates on long duration assets are likely going to be disappointed. I continue to believe that the next 25 basis points move in long rates is down. We're going to have better support for our position in the next 1 to 2 months, but the bond market will probably move before then.
Thanks, Cliff. We'll continue to keep tabs on long bonds and wages. Let's now zoom into the market lens. Now that Congress is back in session, there is talk heating up about the infrastructure bill and the broader $3.5 trillion in healthcare, education, and climate bill. What's the latest you're hearing and what's your take?
Well, I prefer when Congress is not in session, but you're right, talks are heating up. The infrastructure bill is not even worth talking about. It's been so watered down and spread out that there's no economic impact. What matters is that Democrats are hoping to construct a huge, wide-ranging package that significantly expands the nation's social safety net, reduces carbon emissions, and raises taxes on companies and high-income households. We talk a lot about bacon on this show. There's going to be a lot of pork on the menu for this one. I'm not sure I want to know what they're going to try to squeeze into this, but broad strokes, we'll see an extension of expanded Affordable Care Act subsidies, Medicare coverage for dental care, and health care coverage for some in states that haven't expanded Medicaid. Democrats are also discussing how much money to put towards workforce development and higher education, including free community college and universal pre-K, as well as how to administer a proposed paid leave program.
Yeah, this sounds very ambitious. If nothing else, we definitely know that Congress is good at spending other people's money.
No doubt, and they hope that this will be done by the end of the month. We'll see about that. Writing a bill is one thing, but writing a bill that will appease both sides, because this is a huge bill and over contentious topics, so-called free stuff, and higher taxes for corporations and individuals, this will be the biggest bill ever by a wide margin, more than $1 trillion higher than the pandemic-related bill. Right now, lawmakers aren't set on how to spend the $3.5 trillion to the various programs. Regardless of what they do come up with at a $3.5 trillion, it's going to see significant downward pressure in size and reach.
Yeah, even if it's downsized, how is it all going to be paid for?
Well, moderate Democrats are demanding that the full cost of the bill be covered with tax increases and new government savings, though many have also raised concerns about significantly increasing taxes. But there's really no consensus just yet. Some are saying no debt. Nancy Pelosi is saying more than half with taxes and cost savings, so basically just taxes. Higher corporate taxes and income taxes for top earners has been on President Biden's agenda from day one, so this shouldn't be a surprise. Honestly, I can't see how they can raise taxes to pay for it all. They'll never cut spending elsewhere, so it comes down to debt. If they get close to a deal, we'll see how the bond market reacts. It's going to be tight. With very narrow control of the House and Senate, Democrats will have to achieve almost unanimous support for it to pass both chambers. Democrats are using the reconciliation process to pursue legislation without any votes from Republicans who are heavily against the proposals.
Yeah, Cliff, that's an interesting point. I can't believe both sides won't agree.
No, it's shocking. Look, I think $3.5 trillion is an insane bill size, and it's unlikely to get done. We'll see what happens and who concedes. Bernie Sanders is holding his ground, having come down from a $6 trillion bill. He's given up enough of taxpayers' money, and he's holding firm at $3.5 trillion with a T. In all seriousness, what's not being talked about all that much is the debt ceiling. Will they raise it next month? Probably. What's definite is that it will be politicized. Remember the closing of the Washington Memorials in front of all the cameras when the government was out of money. We'll see who gets blamed for what and what ramifications that brings for the 2022 elections. It could hurt Republicans if the media spins that they are going to cause the country to default if they put up a fight, although the sheer size of the Democrats' bill could come back to bite them as being egregious. My sense is that these events will have a notable impact on the 2022 elections. I continue to predict a significant shakeup in the House in 2022, with the Republicans returning to the majority there. My personal hope is that with a little more gridlock, we don't hear about a $3.5 trillion bill paid for by higher taxes for a long, long time.
Thanks, Cliff. A lot to take in there. Can you sum it up for us?
I'm not convinced that anything gets done anywhere close to its current form in this bill, and I don't think that the market is completely buying into it either. I'm not sure it hurts equities if it doesn't happen. Long-dated bonds could see a pop if this bill fizzles, but again, probably won't be a huge impact. Now, if something actually gets done at $3.5 trillion, yes, huge ramifications there. First, in the industry seeing the spending, but also corporate and personal tax ramifications and bond market concerns about how it'll be paid for beyond taxes, meaning more debt to an already heavy debt load. That's not the base case, but if the Democrats pull it off, we'll see some decent shifts in the market.
Yes, we will. Thank you, Cliff. You've given us a lot to digest this week. Also, thank you to everyone who tuned into the Market Lens. We're hoping this is letting you see 2020. Thank you and see you soon.